The W-4, arguably the form that causes the most tax problems for the majority of Americans. With over 90% of the US population making their living through wages, it's no wonder this creates so many tax headaches. And today, we're gonna show you how to fix it. How do we know when we need to fix our withholdings? Is it when we get a new job? Is it when we get a raise? Is it when our spouse gets a new job or gets a raise? Or is it when life circumstances change? Well, if we're like most people, we usually don't get a clue that we need to update or fix our withholdings until it's kind of too late. Hey Jim, it's Mike. Hey, I'm looking over your tax return right now. I wanted to give you a quick call. I remember on our last conversation, you mentioned that your wife, she got a big raise, and you also mentioned that you have not updated your W-4 in quite some time. Well, as I'm compiling your information and putting things together, I'm noticing you're probably
going to owe a lot of money come April 15th.
If you find yourself in one of these situations or want to avoid this situation altogether, then you've absolutely come to the right video, ladies and gentlemen. Because in this video, I'm going to walk you through a few processes that you can implement so that you can completely avoid these issues altogether with your W-4. I thought I'd better add this clip as a disclosure for this video. Now there are timestamps below, so if you need to skip around to any point in the video, feel free to do so. But I wish I could tell you that this process will only take a few minutes. But if I told you that, I'd be completely lying to you. When you first perform this analysis, what will be helpful for you to have is a copy of your last filed tax return, which is probably tax year 2021 when I'm recording this video. A copy of your most recent pay stubs, especially if you have more than one job or your spouse's most recent pay stub, access to publication 15T, IRS publication 15T that is, access to a blank W-4, access to the IRS free tax estimator tool on their website, and probably a few other documents that we're going to talk about in this video. When you perform this analysis the first time, I'll be honest with you, it takes a bit for most people to wrap their head around what they're looking at. So it'd probably take you a few hours to do this on your own. Maybe 1 hour to 3 hours, maybe even 4 hours for you to completely understand the numbers we're going to discuss today. But once it's performed, then you can have numbers to check against. And throughout the year, it will just take you just a few minutes to check your numbers to see if your withholdings are on track for the year. But we're going to discuss that later in the video. So just be prepared that it does take, typically for most people, even professionals like myself, usually a few hours to perform these type of analysis. Okay, with that disclosure out of the way, I hope you enjoyed the video. Now you might assume, and it's totally reasonable to assume this guys, if we currently have an accountant or CPA, we might think that they're going to be watching our back, they're going to take care of us, so we're not going to have to think about this whatsoever. This is never going to become an issue. But believe it or not, that is not likely the case. This is because most people do not speak with their accountant more than once a year, nor do most people do any sort of tax planning whatsoever at any point during the year. As a CPA myself who's been doing this for 13 years now, I cannot stress enough why it's so important that we be building relationships with our tax advisors, accountants, CPAs, and that we speak with them a little bit more frequently than just once per year. If we only talk to them once per year, they really can't help us determine if we need to do tax planning or help us catch these withholding issues before it's too late. Now sure, yeah, it's probably going to cost us a little bit more money to do this, but the peace of mind it brings and potential tax savings may be well worth it. Of course, this sounds great when we have an accountant, but what if we don't have an accountant? Surveys show that less than 50% of the US population actually has an accountant, which makes sense because typically wealthier people have accountants and where the vast majority of people do not. Luckily, there are a few simple methods I'm going to show you in this video to help you mitigate your withholding issues going forward so that you never are surprised again. By us walking through a comprehensive example together, you're going to be able to apply similar techniques to your own situation. And then we're going to look at some other tips and tricks towards the end of the video to help you bring it all together. We're going to bring in Chipper to help spice things up and hopefully make this learning experience more enjoyable. The story begins when we meet Chipper, a single tax filer who has 2 jobs. Yeah, he's hustling, guys. Chipper's highest paying job comes from his work as an auto mechanic that pays him about $50,000 per year on salary. And Chipper, he loves cars so darn much, he actually takes his time to sell them on the weekend as well. And by selling cars on the weekend, he makes approximately about $25,000 a year on average selling cars. But just like most people, Chipper has little to no knowledge of how taxes work.
Where's all your money gone, Daddy?
Taxes.
When Chipper started his second job as a car sales rep, he failed to update his W-4 at his auto mechanic job, his highest paying job. This mistake will cost him dearly, and his day is about to get a whole lot worse. While at work, Chipper receives a phone call from his accountant. His accountant informs him that he will owe just over $4,000 to the IRS and $2,000 in state income taxes. Shocked by the new information, Chipper asks his accountant why he owes so much. His accountant informs him that his withholdings have been wrong for almost the entire year. Frustrated with little money in the bank and bills coming due, Chipper is forced to take an installment agreement out and goes into debt with the IRS. Okay, poor Chipper. He's getting hit left and right with these taxes. What do we do to help him fix it? And what can we do for ourselves if we find ourselves in a similar situation? The truth is, this situation could have been completely avoided and Chipper would have never had to go into debt with the IRS. His lack of education around taxes set him up for failure, and he's about to learn by working with his accountant what he needs to do moving forward to avoid this situation in the years ahead. With the following processes in place, we can stop this from happening to us altogether. Step 1, project our taxable income for the year. If I were Chipper, the first thing I would have done would be project how much income I would make by end of the year. As an auto mechanic on a salary, we should know approximately how much we'll make by year end. In this case, it's going to be $50,000. Now, working as a car sales rep is a little bit trickier because we work on commission. It's a little bit harder to project, but I would try to estimate the average amount of cars I sell every quarter to project my total commissions by year end. The estimate may not be totally accurate, but it will give us an initial target to aim for. Having a target is better than having no target at all. Step 2, now we're going to take our projected taxable income and we're going to use that number and information to help us project our total tax liability for the year. Using the free IRS tax estimator tool on their website, we can quickly and easily project our tax liability in about 10 minutes or less once we're proficient at it. And the great part is we can do this exercise as many times as we want because there's no limit to how many scenarios we can run using their free tool. To ensure the most accuracy, I would want to have my most recent pay stubs available from both jobs, but we don't necessarily need to have them, as all we're trying to do is project the total tax liability for the year. This is a crucial step, and if we get it wrong, our tax projection will be wrong as well. Using the IRS estimator, we first input the source of income based on our income type. We then move down to describe how long we've held a position. Next, we are asked how frequently we are paid. Bi-weekly would be every 2 weeks. And at this stage in the game, we would think we would enter our total annual income here, but actually what they require is to enter the average amount of salary per payroll. If this number is entered correctly, you can see that it will estimate how much we will make. If we assume we're going to receive $50,000 by year end, that means our average payroll is $1,923, received 26 times throughout the course of the year. Lastly, we will enter the average amount of federal income taxes withheld per pay period. We will learn how to arrive at this number later in the video, or at least what this number should be. Since we're assuming we're starting the job as of January 1st, we're entering 0, as no income taxes have been withheld just yet. Using the IRS estimator tool, we will repeat this exact same process for the second job as well as a car salesman. So assuming we're paid bi-weekly like in the first job, that means we will have received on average about $961 per pay period. For the sake of this example, we're assuming we have no other material sources of other income. If you have other sources of income, I would suggest funding that tax obligation using estimated tax payments discussed later in the video. I'll leave it up to you to determine if you want to include that in this estimated tax projection or if you want to leave it out. Perhaps do it both ways and see what the differences are. Can you guys see why figuring this stuff out is so complex? Because essentially what tax planning is, it's kind of like preparing a tax return before you need to prepare a tax return in order to arrive at what the projected tax liability is. With the IRS estimator tool, you'll also include your adjustments to income if you have any, and it's extremely important to also include if you itemize or take the standard deduction, in this example, we're taking the standard deduction. One of the areas where people go wrong with this is that they forget to include all the tax credits they might qualify for. So make sure you include all the available credits so that our calculation is as accurate as possible. Like I said, it's like preparing a tax return before you need to prepare a tax return. This is where having a tax return available, your prior year tax return, it can really come in handy and pay us dividends, because we can then look at our previous filing to determine what type of tax credits do we usually get. Is it the child tax credit? Do we not get the child tax credit? Can we expect to get it again? That's why having a tax return to look at and seeing the complete picture of your normal tax history will really help you fill this out accurately. If you're doing it without that, you're probably missing a bunch of things that you don't even realize. To save us time and headaches, I would actually take a moment at this stage and review my calculations in step 1 to absolutely make sure my taxable income projection is what I think it should be. After walking through all the input screens, we will arrive at our projected tax liability. Speaking of projected tax liability, how do we know how accurate we are with our projections? Well, when you go to file your tax return, that projected tax liability we were just looking at should be the amount shown on line 24 when you go to file your taxes. So compare it against when you actually go to file your tax return for that year and see how close you got to the real number. All right, things are getting real now here, ladies and gentlemen. In step 3, we're gonna take that tax projection, that number that was just projected from the IRS estimator tool, and now we're gonna start to compare our withholdings on our actual pay stubs against that projected number to see if we're on track. If we're on track, then we should be relatively close to having no tax liability due or getting some sort of a refund. Taxes and income can fluctuate so much, but if we've done our projections carefully and correctly, we should either be in the range of getting a $1,000 refund, up to a $1,000 refund, or owing only up to $1,000 at most. Knowing our projected tax liability, we can then easily calculate where our total withholding should be throughout the year. With our pay stubs, we can check total year-to-date federal tax withholdings against our projections. By knowing our projected tax obligation of $9,493, which we got from the IRS estimator tool, we can then quickly and easily see if we're on track with our withholdings. So for example, by the end of quarter 1, which is March, end of March, we should have withheld from our pay stubs, from our 2 different jobs we have, in total $2,373.25. When we're looking at the row on our pay stub that says federal income taxes withheld year to date, we would add up those numbers from both jobs and then compare it against this projection right here to see if we're on track. If by September, we should have withheld about $7,119, and by the end of the year, we should have withheld $9,493. If, as we're going along throughout the year, we take a moment and we compare our withholdings from our pay stub against these benchmarks. If we find our withholdings are lower, then we know we're probably going to owe money if we don't do something about it. Or if our withholdings from our pay stubs are drastically higher than these numbers, we can realize very quickly if we're going to get a refund. Now we've made it to step 4, which was one of the final steps. In this step, we're actually going to focus on updating our W-4 at our highest paying job. Believe it or not, this actually works for married couples just the same. Meaning, if you and your spouse are both working, the W-4 you're going to update is the spouse who has the highest earnings. That's right, your sugar mama or sugar daddy is footing that higher tax bill. Grabbing a new W-4 online, we fill out the information in step 1 and then immediately proceed to step 2. Since we have multiple jobs, we are instructed to go to page 3 of the W-4. Following the instructions, we will eventually determine how much extra withholding should be taken out of our paycheck at our highest paying job. Continuing down the line, we determine the point at which our income from our highest paying job connects with our lowest paying job. This number happens to be $4,610. We then take this number and divide it by the number of pay periods, which is 26 in this example, because Chipper is paid bi-weekly. We arrive at $177. This is the amount of extra withholdings that will come out of each of our pay stubs going forward and will be listed on the first page of the W-4, line 4C. There is an issue though. We just calculated the extra withholdings, but we still have no idea what the actual standard withholding amount is. Luckily, IRS Publication 15T, which I mentioned in my last video, can help us with this. Using IRS Publication 15T, we can use the withholding tables to arrive at what our standard withholdings should be from each of our respective jobs. As you can see, there's a lot of little tiny steps and data gathering and data collection that you need to perform in order to do this analysis properly. And what I suggest is get those numbers out of your head and either write them down on a piece of paper as you discover them and as you locate them, or use Microsoft Excel or something similar, Google Sheets for example, to summarize and store all the data in one place. That's what you're about to see me use, but use whatever method works for you. By following worksheet 2, which is found in IRS Publication 15T, and going to the withholding tables, we quickly determine for our highest paying job that our standard withholdings should be about $163 per pay period. We then add the additional withholdings we listed on line 4C, and the combined number is about $340. This number, it will fluctuate on us up and down throughout the year if our pay changes. However, approximately or roughly, this should be the number coming out of each and every one of our paychecks at our highest paying job. We then repeat this process for job 2. Luckily for job 2, it's a whole lot easier because we do not need to calculate any additional withholdings for job 2. We were only supposed to do that for our highest paying job. In this example, we only fill out step 1 or part 1 of the W-4, sign the bottom of the form because we have no dependents, and send it in. By using the withholding tables in IRS Publication 15T, we determined that for job 2, that our standard withholding amount per pay period should roughly be $48 per paycheck. With this new information and adding our withholdings together from both jobs, the average withholdings that we can expect, we can reasonably estimate what our total withholdings will be for the year. We compare our combined projected withholdings against our projected tax liability for the year, and we determine that with these numbers, we should receive a small refund by the end of next year. Throughout the year, we will occasionally check our pay stubs against our projections to ensure we are on track for success. Okay, ladies and gentlemen, let us review. Number 1, we're going to start by projecting our taxable income for the year. We're going to then take that number and use it to project our total tax liability for the year. We're then going to compare our pay stubs and the total year-to-date federal income tax withholdings and state income tax withholdings, because you can do it for both if you want, against what our projected tax liability for the year is. We're then, if we see that there's something wrong, we're going to update a W-4. The W-4 is going to be updated at our highest paying job. And if we're married and we both spouses work, we're going to update the W-4 for which spouse? The spouse with the highest income. And then lastly, a few times throughout the year as we're going along, we're just going to take a few moments and we're going to check our withholdings that are being reflected on our pay stub against what our projections are to make sure there's been no major life changes or any reason that would throw our numbers and make them materially incorrect. By doing these steps each and every year, it takes a few minutes. You're gonna never find yourself behind the 8 ball when it comes to taxes ever again. If we have other types of income like rental income, business income, dividend income, interest income, or other types of investment income, or any other type of income, hopefully you get the idea. But as a CPA, what I find to be the easiest is to take those income amounts, keep them completely separate from your W-4 calculations. I find that by just using the W-4 for wage income, it will be the most accurate and easiest to maintain. For all other types of income, I suggest using estimated tax payments to fulfill your tax burden with those income sources, which is a separate tax calculation, and I have another video that can address such matters. Although there is one exception to that, is if you have retirement distribution income that you get every single year, you can withhold money on that. So for wage income and retirement income, I would probably suggest withholdings. Anything else, completely use tax estimates to fulfill that tax obligation. Couple of last minute pointers. Do you have to update the W-4 with the highest earnings to correct your withholding issues? No, you don't necessarily have to, but it makes the most sense to do so. There's a lot of ways, or there's more than one way to fix your withholdings. If we are married and we have children and we both work, when we're filling out our W-4, a common error I see all the time as a CPA is that each spouse, when they're filling out the W-4 at their company, is they're listing that they have dependents. That's a huge no-no. Only one spouse should list that they have dependents. The other spouse should not, to ensure that the proper amount of withholdings are being taken on that income. Otherwise, what they're doing in essence is double counting their dependents, which is going to completely skew their withholdings, and which is causing couples to owe thousands and thousands of dollars to the IRS, and they don't even realize it until they file their taxes. In the comments, let me know what type of withholding or tax issues you've ran into in the past and how you went about remedying the situation. Like the video if you found it helpful, and it would help me so much if you share this video with others. That's the only way this channel grows. I really appreciate your support. If you are seeking professional accounting or tax services, I can help you. I've been able to help clients across the country. You can contact me by visiting my website at MikeKellyCPA.com. Fill out my intake form and we'll be in touch to schedule a potential meeting. To help you solve more of your business, money, and tax issues and other topics, make sure you subscribe to the channel and check out this video next, because I think you're gonna find it helpful. I hope you have a wonderful day, and I'll see you in the next video.